it was a very good opportunity to make a crash test in our relationship with also the management of the companies under this crisis, and see how things are moving in tough times, which did well. It was okay, it went well.
If you're the founder or CEO of a startup, to look at every possible way, even if it's painful, to extend your runway. And the other reason that's really important may not be as obvious, because I can tell you 6 months from now, when things finally, let's hopefully in 6 months from now, when things normalize, when you walk into an investor's office as an early stage company, they're going to ask you, what did you do during the COVID crisis to better manage your business? And if you don't say you took those sorts of aggressive steps, they're just going to look at you and assume you're not the kind of CEO they want to invest in.
Thank you very much, everyone, for joining. Welcome to our panel. So the structure of the panel will be as follows. First, I introduce Astra Global a little bit. Then panelists will introduce themselves. We have about 15 minutes to an hour for the panel discussion on the current trends in the digital health and biotech. And then we will have a pitching session. All of you guys received score sheets with companies that will be pitching. We would be very grateful if you could fill in the score sheets. So first, let me share this. So first I want to use Astra Global is a global company matching investors and high potential startups. We operate both in Europe and in the USA. So our services include warm introductions to investors, high net worth individuals and corporate companies through our network, which we have throughout our activities such as events and also through our partners and background. We can also do deal structuring advice. I personally was involved in private equity as an M&A lawyer for about 10 years. So we can review your term sheets. It's mainly for startups and help you with negotiations with investors. Do this event also with the partnership with Gold Ventures Investment. The company helping us with valuation of startups and also with actually getting grants, public grants from European Union for startups, which can be matched with the venture capital and thus reducing the risk for venture capitalists. So if you are interested in such grants, please let us know. So I would like to introduce our panel and I will let them introduce themselves. You have maybe 1 minute of introducing your fund and who you are. Let's start with Yervand.
Yeah, thank you, Elena. Thank you for the invitation. Yeah, my name is Yervand Sarkisyan. I'm originally from Armenia. I lived in US for some time, then in Germany, and for the last 15 years I've lived in London, initially in Cambridge and then in London. I'm a founding partner in early stage tech focused fund. We invest primarily in machine learning and AI and deep tech companies with connection to Armenia. So some of our investments are in UK, some in US, and some in Armenia. So there's 3 regions. And currently, health tech and food tech, those areas are very exciting. So I'm looking at those more actively. Thank you.
Konstantinos?
Yes, hello, my name is Konstantinos Maramenos. I'm the origination manager of Brookstreet Equity Partners. We are a UK-based FCA-regulated private equity house. I would say we would position ourselves as a growth cap investor, meaning we focus on scale-up businesses, not startups, but companies that have overcome the so-called valley of death and are ready for the next step. You can call it a Series C or Series D investor. We operate a proper GPLP structure, managing international private money. And our geographical focus is pan-European, with a special emphasis in Greece because of the strong network we have there. Myself, I'm here as well. And we're sector agnostic, but we want to search for innovation, exports orientation, intellectual property, and good management.
Thank you. Richard? Did I see him? Maybe he's not here. Okay, Adam?
Hi, Elena. Thanks for the invitation. Delighted to be here. I'm Adam Dakin, Manager and Director for the Health Tech Vertical at Dreamit Ventures. We're a sleeves up venture fund. We're in Philadelphia. We focus on 3 verticals: health tech, urban tech, and secure tech. My team is the health tech team. We're a little bit unique in that we run what you might call a late stage accelerator. We prefer to call it a growth platform alongside of the fund. We only invest in companies that go through that platform. It gives us, we pride ourselves on adding a lot of value to these companies. We get them access to a network of nearly 70 enterprise healthcare systems, payers, large multinationals, big pharma partners, which really slices a lot of the time off the front end of that sales cycle. And then we do the same thing on the back end with a network of nearly 1,000 venture investors that we can introduce them to. We're pretty good at it. Over half of our companies will go on to close a slate seed or Series A round after completing the Dreamit program, and that really is our strike zone. And much like Richard mentioned, we're looking for companies that are already in market, they already have customers, and it's all about scaling the business and raising capital to support that commercialization effort.
Great, thank you, Adam. Sean?
Yeah, so I'm Managing Director of SOSV, and SOSV runs the accelerators IndieBio and Hacks, and China Accelerator, Mox, FoodX, and 1 or 2 others. We're the most active investor in life sciences and in hardware in the world, and we invest generally in 150 new startups every year out of the 8,000 or so that apply in those areas. We have, in life sciences, our offices are in San Francisco and New York now, and in hardware, it's San Francisco, Shenzhen, Tokyo, Xi'an, and in China Accelerator, it's in mainland China, Taiwan, and now investing a lot in India as well.
Thank you so much, Sean. Sergey.
Hi, everybody. My name is Sergey Kovalenko. I'm co-founder of Bravo Capital, and Bravo is a funding platform mostly for mobile businesses. So like all our companies, they're mobile first, and this is like a unique funding model. So we're providing non-dilutive capital for all our companies. Right now, we have close to 150 companies in our portfolio. Mostly it's a health, fitness, nutrition companies, and we work with companies from 27 countries right now, and majority of all our companies that we working with, this is a very fast growing company. So like we helping them with user acquisition, and we help them to continue growing their business and just be successful.
Okay,
thank you.
Great. Ingrid. Ingrid, are you here?
Yes, you can hear me now. Thank you, everybody, for allowing me to participate today in my role as a senator of the WBAF Angel Investment Fund. What I usually do is I work with startups for our global startup competition, which happens once a year. We cover about 85 to 100 countries, depending how you count. And we have a broad investment portfolio across all industries. Of course, digital health, biotech, and pharma are always in everybody's portfolio that has such a broad global coverage. And it is my pleasure today to participate. I also teach in the World Business School that is affiliated with the WBAF fund, and that's another opportunity where I work not only with startup entrepreneurs, but also with investors alike. Thank you.
Thank you. Julio, I didn't call you, I guess.
It's totally fine.
Sorry.
So I'm Julio Marquez. I with New York Bay Capital. We are a combination of investment bank, more like an advisory firm, and also an investor, because we have a sister fund called New York Bay Blue, which makes investments. So, well, we typically, our model is that we have clients and we make sure that those clients fit various profiles, and then we go out and raise capital for the clients. We always offer investing alongside our capital sources in our clients, so that people know that we put our money where our mouth is. So some people believe that that's like a merchant banking strategy. But we're active in the biotech sector. Recently, we've worked and raised capital and invested in invested in companies like Epibone, which is in bone regeneration, Oi Health, which is in telemedicine, and Sorrento Therapeutics, which is a it's publicly traded company in various things, including non-opioid pain management. Although they're now recently have been making headlines because of their COVID. So we're open to more clients and investments. Personally, I'm a member of the Harvard Business School Angels of New York, as well as the MIT Angels of New York. And so we certainly, you know, I look at everything from a very early startup phase to, of course, develop companies like the ones I mentioned. You know, one of them is already in the, it's already trades publicly. So thanks for the invitation. Look forward to the discussion.
Thank you. Amy.
Sure, I'm Amy Salzhauer. I'm sitting here today in Charleston, South Carolina. I'm one of the managing partners of Good Growth Capital. We are world-leading experts in technology commercialization, so we invest very, very early. We have two families of funds, a seed and Series A fund, and then which we just call our general funds, and then the Infinite Carter Fund, which focuses on pre-seed and seed investments primarily out of MIT and then in transformative science. We do take some investments that aren't MIT affiliated if they really fit that bucket of transformative science. We do a huge amount of work with our entrepreneurs. We usually have worked for about a year or more with most of our entrepreneurs before we invest in them. We also are a majority women-owned fund, and we invest an impact portfolio, even though we invest for the highest possible return. So we invest in health tech and bio if there's exits within 4 to 7 years, in green tech, mostly advanced materials, and then in data science and physics and chemistry focused companies. And our health tech portfolio has about 1,000x return. So we're pretty strong in our health tech.
Great. Thank you, Amy. Varvara.
Hi, my name is Varvara. I'm representing the Arici family office. Previously was a medical device founder and then VC in San Francisco. But the family office is of the founder who is literally located throughout the globe, primarily in Singapore and Switzerland. I personally share those two locations in addition to San Francisco. We focus on health tech, sport tech. Because it's a family office, there is no such drive of allocation particular budget, but there is a drive to invest wholly in our portfolio companies. So sometimes we do get involved in active support and business development or any connection wise. The founder is himself a very successful serial entrepreneur who has built more than 20 companies, primarily in IT. His main company right now is Granatus at cyber protection. And with that, I'm also driving support of life science effort throughout startups. We've actually did a partnership offer to SOSV recently companies, just because I had my personal investment in one of SOSV companies in life science. So we're hands-on and one of our favorite fields, aside from our own fund, there are 2 or actually 3 venture funds that the founders started, and there we invest in IT and deep tech. My personal focus is in health tech, diagnostic, sport tech, and very big fan of preventive and predictive, and especially excited at what the world will show us in healthcare of the future due to the current situation and extraordinary innovations coming because of that.
Okay, thank you so much. So let's start the discussion. Actually, we have a list of questions that we were supposed to discuss, kind of, but I want to change it actually. Can you share your worst case and your best case COVID adaptation scenario which you experienced through those months? Who wants to start? Sean?
Sure, I'm happy to if nobody else will. So our best case COVID company is a company called Illuna. Illuna has a machine learning focused spirometer that can predict an asthma attack. So their first customers are children with asthma and children with cystic fibrosis, and then they'll move into COPD. They were in pilots with 2 different hospitals in California. And what happened when COVID hit is that the doctors involved with those pilots got compassionate use clearance for Illuna's product. She shipped all of her inventory to those hospitals. And then when we reached out to say, how can we help you in this particular market, she said, I shipped all my inventory. I guess, could you fund me rapidly so I can make some more? So we wrote her a check, and 5 hours later, she had FDA clearance, full FDA clearance, which was really not expected for another 12 months. So COVID really just, catapulted her forward.
I guess because we had a best case, I'll give a worst case. we had a company in Brooklyn which is doing very great company, great growth, 8 million in revenue, 40 people manufacturing their products, huge, very, very positive growth track. And they had to, furlough all their workers in order to survive over the last 3 months, just because if you can't manufacture the product, if your people aren't allowed to go into the factory and make the product, there's very little you can do. So in order to survive, they laid off all the workers. They are starting to, we actually haven't, I'm not aware of a company that we've completely lost, but they will be fine in the end because they had a great business before, and they're restarting production now. So hopefully that'll be a better outcome in the end. On the best case side, we also had another company in Brooklyn that makes called Opentrons, that makes lab automation equipment, and they went from say 10 million or so in revenue to over 30 million in revenue during this period, and opened up. They hadn't been in the diagnostic market before. They were in other sort of liquid handling robot applications before, and that's just opened up a whole new market for them, a long-term market potential. So that's not a bad one. And we also have about 30 companies that pivoted to support COVID, including some antiviral therapeutics, some antibody therapeutics, diagnostic tests, and I think 2 or 3 of them have been featured in the New York Times as sort of breakthrough companies in those spaces. So we have a lot of shots on goal for COVID.
Go ahead. Go ahead.
Yeah, allow me to give another example of ourselves. A portfolio company of ours called Nanofos. It's a performance chemicals firm utilizing nanotechnology to create coatings. And as you can imagine, because of the crisis, the sales pipeline was put in risk. So both in the B2B channel of large projects that were postponed, as well as the B2C channel. So what we did to respond to the challenge of the crisis was to sit down together with the management and capitalize on their experience and their intellectual capacity and introduce a new product range regarding sanitizers and cleaners. So within 3 months from brainstorming and basic conception, we managed to put in the market more than 15 SKUs. We review the branding, the packaging, and all of that, not plain sanitizers, but sanitizers enhanced nanotechnology. And actually, we're going to file a patent with MOFO, the New York office. And it was a very tough project, and put down our relationship with the management. We sit down, we took decisions, we roll up the sleeves, and within 3 months we managed to launch a new SKUs and completely new business unit. And actually, this is going to be a case at Harvard with Linda Applegate is overviewing that the case writing. So it was a very good opportunity to make a crash test in our relationship with also the management of the companies under this crisis, and see how things are moving in tough times, which did well. It was okay. It went well.
I could talk about the three companies. I mean, we are in various industries, and I can tell you some industries have been hit very hard, like fashion, for example. We're active in the fashion industry, but fashion right now is very difficult. But since this panel is about biotech, the three companies that we know really well, they're all different stories. The first one, Epibone, the bone regeneration, that was hit very, very hard by the crisis because it's all about R&D. It's they don't have EBITDA yet. It's all about the FDA and our R&D, and of course things have had to be shut down. People not being able to go to the office means some of the experiments are in danger, and the company will be fine because we have a great bunch of investors. But that's biotech, when it's about FDA approval, if it has nothing to do with COVID, has suffered. Number two, Oi Health, it's a telemedicine company, and what was great about it is it was in telemedicine before telemedicine was a thing. About 3 years ago, they started this idea of telemedicine because they focus mostly on Latin America and on Spanish-speaking audience, and they felt that that kind of population did not have access to good medical advice. So they started with telemedicine, and now, of course, because telemedicine has boomed, it's been a direct beneficiary of a lot of attention. And finally, Sorrento Therapeutics, the ticker is SRNE on NASDAQ, was a cancer company that had then made an acquisition in non-opioid pain management, which was a thing about a year ago or two, because opioids are, as you know, are very addictive and have all kinds of problems. However, some of the R&D has translated into COVID applications. And if you ever look at this stock, this was a company at around $2 per share, which is now trading at $5 and even reached $7, just on the basis of some COVID announcements that they've made. I think it's because the management is not only very smart, but it's in many things, and it saw the opportunity to apply some of its body of research into for the benefit of the COVID R&D. And so that's been a good beneficiary some days when the stock goes up, but then other days, because it's too early to make any kind of real, concrete announcements about things, whether they're working or they're not working, it goes down with the market, and it's taking us on a crazy ride from 2 to 5 to 3 to 4 to 7 to, but it's been fun. So biotech is obviously a really exciting area to be involved in right now.
I'll jump in. So we're a health tech investor, which for us is really med tech and digital health. The vast majority of our companies focus on enterprise health systems, which is not an easy place to be selling to right now. As you can imagine, the C-level executives at those organizations are heads down. It's sort of like all COVID all the time. So getting them to look at new platforms is not easy. And the reality is that sales cycles for most of our companies are pushing out. Healthcare systems, as most people know, are losing a lot of money right now. One of the health systems that we work closely with is losing $100 million a month. So getting in front of them to look at new things is hard in the first place. And then the budget is the next issue. As one of the head of innovation said to us, it's all about cost right now in capital letters. So, there's no easy way to sugarcoat it. If you're a startup, you've got to be thinking about extending your runway right now and surviving through all this. And I think, Elena, your question sort of highlights the fact that I almost think there are three buckets of companies right now. Companies that truly have a tailwind because of COVID, and I'll give you two examples of those. Companies where this is clearly a headwind, there's no getting around it. And then I think there's this third bucket of companies which are trying to morph their value propositions to fit the pandemic universe. I call them the COVID contortionists. Unfortunately, I think that's usually pretty sophisticated investors will sleuth out that your value proposition for COVID maybe isn't really that compelling. But I think a lot of companies feel like they need to make hay while the sun shines. It's probably a mistake for the vast majority of companies. But we hear, geez, probably 1,000 pitches a year from startups, and it's sort of frightening how many of them will say, oh yeah, no, COVID is great for us. And it only takes a handful of questions to realize, no, COVID's not so great for you, right? You're not going to get through this budget cycle. Your sales cycle, we have companies who've extended their sales forecasts out 12 months. Those are the ones who are being realistic. So two quick examples of companies that I think really do have tailwinds. We have a company called Asparia. It automates workflows and patient communication, makes it really simple for a provider to figure out who among their patient population they need to reach out to, what messages need to be sent. A particular example for COVID was they went live in less than 24 hours in a healthcare system that wanted to screen patients before they came in for their visits to determine whether or not they had COVID-like symptoms. If they had those COVID-like symptoms, they wanted to pivot from an in-person visit to a telehealth visit. Great use case, very strong management team, and they've been just gaining tremendous momentum from similar types of automating similar workflows now that healthcare systems need to deal with this remote patient population. Another great example of a company that has the wind at its back is called Elemento. It's a point of care on-demand training platform. So now you have frontline providers in positions they probably haven't been in the past. There's no opportunity to bring them into a room and teach them how to do procedures correctly, how to put on your PPE, the right way to do a nasal swab. I never knew you could do a nasal swab wrong, but trust me, you can. So people need to be trained in the proper way of doing even simple procedures like that. And guess what? Doing it in 60 seconds on your mobile phone is an ideal way to train those frontline providers. So for them, COVID truly has been the wind at their back. And then finally, maybe one that's not going so well, we have a genomics platform. It enables providers to use genomic information for pharmacogenomic decision-making right at the point of care. It's a very compelling platform. Yet, that's one of those examples where the providers are heads down saying, sorry, don't have the bandwidth to look at this right now. One of the heads of innovation that we do a lot of work with, huge Dreamit supporter, has probably piloted close to 10 of our companies, just said, hey, Adam, love Dreamit companies. I'm spending all day, every day sourcing ventilators right now, so you'll forgive me if I don't want to talk to your companies at the moment. So that kind of gives you maybe a sense of the good, the bad, and the ugly for what's going out there in the health tech world.
Right.
I have a few more if you want. If not, we can move on.
Yeah, please share.
So I will give different examples just so that we keep it balanced. I can give examples of two blockchain companies that had tremendous success when, for the past 2 years, no one wanted to deploy their platforms. Now, all of a sudden, they were able to immediately scale, and they actually scaled internationally. One of them focused on clinical trials, and when the FDA, I think someone else mentioned the FDA can be good or bad, but in their case, it was excellent because the FDA allowed virtual trials and actually recommended virtual trials. So this company did blockchain, e-identity, full clinical trials management for the patient and for the institution and for the clinical research organization. So that was very nice. So that's one example that worked well. The second one does precision medicine and blockchain. And again, with COVID, finally people understood what does a good use case look like. Before, it was very difficult for people to understand how an international platform powered by blockchain and that also deploys AI and genomics, but for pharma industry, it wasn't bedside, just to Adam's point before. how it could play a role in international R&D. So again, due to COVID, all of a sudden, several use cases became highly eloquent. You didn't have to even pitch anymore. Everybody understood. And then I think someone else gave the example, telemedicine, same thing. They had success before, but overnight, due to COVID, all the ambulatory offices, of course, were closed. And specifically two, I can give an example that focused on pregnant moms. They offered telemedicine for pregnant moms. So you can imagine no pregnant mom wanted to go to any office. So 3 examples where it worked really well. 2 others that I can share are also related to much more in-depth AI utilization for massive data sets. So I think, again, overall, we see that health tech did fairly well compared to other industries. That would be a summary. Thank you.
Yeah. Do you think that this COVID, the whole situation, thank you, sorry, Varya,
No,
do you think that will boost the technology? And please, Ingrid.
Yeah, I'm happy to actually combine both of those questions. My example is one of our portfolio companies. They're a diagnostic technology out of Harvard based on quantum physics, actually. So not traditional biochemistry, which is magical in a sense if you go deeper in this market, because traditional biochemistry requires multitude of sample preparation, like 8 steps, and that one just shutters that sample preparation and removes the problems of potential risks and wrong results. I believe COVID highlighted how important it is to have a correct test and timely and cost efficiently. So having them in our portfolio, we've witnessed how they were quick and actually focusing on seeing if their technology is capable of detecting not only traditional proteins, but also infectious diseases without PCR, without, again, different approach towards diagnostic. And what we found out that this technology not only can detect, but because it is a different technology, can combine both detection that the test is A positive, but it can also detect right away the immune reaction. So not only we can understand that the person is A, sick or not, we can understand how far along his immunity was hit and what should be taken into account for treatment. And that's exceptionally important for doctors at ER, because oftentimes we cannot understand if positive test means anything, and we should be looking at the person more carefully and predicting and actually preventing. So that's an innovation and a positive upside in expedition of such innovation while pandemic.
Okay, so what did you change? What did you change for your current portfolio companies in terms of cash runaway versus product advancement versus sales, go-to-market strategies? Like in general, how did you adjust to the COVID?
I can jump in on that one. I mean, first and foremost, it's really all about extending runways. We don't know what the COVID funding environment is going to look like. We certainly have companies who've had term sheets pulled, deals that have been retraded after the term sheets were signed. So I think we're still trying to figure out where all this lands. It's not a nuclear winter out there. We did 3 deals in the last 2 weeks. One of those deals raised more money at a higher price than we were expecting. So look, investors have to deploy capital. Deals are still getting done. On the other hand, there clearly are some investors who are pulling back. So you need to have 12 months at least of runway. And if you don't have that, you should be very aggressive right now in figuring out how to cut your spend, negotiating with your suppliers, all your contractors, your landlord, thinking about, you know, are there cuts to your staffing that you need to make? Never an easy decision. And because obviously you can't thrive if you don't survive. So right now, I think it's incumbent, if you're the founder or CEO of a startup, to look at every possible way, even if it's painful, to extend your runway. And the other reason that's really important may not be as obvious, because I can tell you 6 months from now, when things finally, let's hopefully in 6 months from now, when things normalize, when you walk into an investor's office as an early stage company, they're going to ask you, what did you do during the COVID crisis to better manage your business? And if you don't say you took those sorts of aggressive steps, they're just going to look at you and assume you're not the kind of CEO they want to invest in.
Yeah, I can add as well. It's the same story. Yeah, extending runway and focusing on cash for most of the portfolio companies. In my case, and there is with the last question, there is a company which performed very well. It's not health related. It's in communication, so it's really removing noise from calls like this. It's work from home and call center, so and it's in a trend. So they're raising large Series A right now. That's the kind of exception. But the rest of the companies, yeah, it was I think the opportunity for the companies to refocus and to really understand what's necessary, what's not, and to become much leaner. For example, we also have a company in food delivery which started growing, but they also had large costs, and now they are completely focused on profitability. So it's completely different focus and outlook. So profitability, resiliency, and making sure that you stay in the game until the times improve.
In my opinion, you need to have a multi-pronged approach. I don't think sequence works. I've been working with a lot of companies to try to push them to do what everybody said, definitely extend your runway, but also think about pivoting. You can't be hoping that everything will just disappear and you'll resume business as normal. So I would suggest that even those that don't necessarily feel convinced that they have to pivot, at least to start thinking about how they would pivot if they have to, and how to realign the business, even if not pivoting completely. So in general, I would recommend doing all the strategies you mentioned, and then when they are sure that they need to implement, they can go full force. But I've seen a lot of people saying, like we heard Adam mentioning, that they just do nothing, hope that everything will go away. That's not going to be the case. There's going to be a large impact that for some industries can even last up to 24 months. So doing nothing and hunkering down does not work, I think. That's my opinion.
We invest very early in really value-based companies. Our portfolio is up across the board, but we're very hands-on with our portfolio and with our CEOs, and we also started talking about runway. The other part, though, is that we have 90 co-investors, and we felt that it was our responsibility for our CEOs to help them sort out what is likely to happen with those co-investors. We're also in the middle of raising another fund. So we took that as an opportunity to say, we know we want our portfolio companies in the next 36 months will raise about $360 or $380 million. We want about 50 some odd million of that. We're only raising a $100 million fund with a $150 million cap. So we have changed who we're talking to in terms of that fundraise to try and make sure that the investors we're talking to are investors who really like to do co-investments, and that just within our own LP base, we would have the capacity for that $350 million, because some of the funds are not going to be able to raise another fund, or they're going to be spending everything propping up things that are a mess. And we want our portfolio companies not to run into that challenge, which I guess I worry about that because I'm old and I saw that happen in 2001 and in 2008. And I'm sure a lot of other people who are panelists here saw the same thing, so.
I think a challenge for people who run accelerators like SOSV does is that the angel investor network is very uncertain right now, as all of us should be, about what the follow-on investment is going to look like. So as a result, we're actually slowing down our pace of graduation, and we're spending this year is the year we're giving more love to our startups than ever before, even though we've always given them a ton of love, because we may spend, instead of the 3 to 6 months or 4 to 6 months that we normally spend with a cohort, we may spend 7 to 12. And helping them with their business development, helping them further with additional cash if necessary at the accelerator stage. We give $250,000 at the accelerator stage typically. If there are no angel investors, in many of our accelerators, it's not really angel investors anyway, it's seed investors, and we're seeing less of an issue there. People that have capital want to deploy the capital into strategically important companies. But on the angel side, we're seeing everybody's putting their hands in the pockets, and I can fully understand why.
If we have time, I have something to share as well. So majority of all, it's like the whole portfolio of Brava, it's a mobile app company. So it's a B2C sector, and we have several companies in health, fitness, nutrition, mental well-being. Because of COVID, actually the user pattern is dramatically changed. Nowadays, everybody's sitting home, working from home, and just like this picture lasts 4 months. What we see, it's a great opportunity for our customers, because the usage of mobile apps, specifically in fitness, nutrition, mental well-being, changed, and we suggested our clients, our companies, to increase the marketing budget on paid user acquisition. And majority of our companies, like in our portfolio, they almost double their revenue during these last 2.5 months. Because of that, it was not planned, of course, but the reality is that because everybody working and just like not leaving home, we see that for this type of companies, this is a great opportunity to continue growing and just like to have more customers, more paying customers. Of course, it's information asymmetry right now, because from other hand, a lot of retail companies struggling, and they cannot spend more marketing budget on user acquisition on Facebook, on Google. But for mobile first companies, this is a great season, not only in digital health, but also for gaming companies, for app util companies. So like we see that, yeah.
Great. So what about this question, corporate VC versus financial VC? What COVID has surfaced having them in startups cap table? Any ideas?
I'm sorry, Elena, you cut out. Might you say that again?
Yeah, can you repeat the question exactly?
Corporate VC versus financial VC. So how having them in a startups cap table, how during COVID those different VCs acted? Different types of VCs.
Well, I'll just say that corporate VCs, depending on which sector, like if they're in the food sector or some of the, it really depends on the sector. Some of the sectors are doing great. A lot of the in health, it's iffy. If you're doing pharmaceuticals and you can't do any trials and everything is going to shit, you may actually, because you can't do clinical trials right now, blah, blah, blah. Everything is really uncertain. And so they're maybe cutting back on some of their spending, et cetera. So it's not the same opportunity. It's not the clarity that people like to have when they're thinking of innovation. A lot of people talk about this COVID period as when innovation will stop. I actually don't think of it that way, but I think for corporations, you know, there's a tendency to go insular and think of what's the core business and shut off other things unless they're really high pain points. So I think it's probably net effect is to take more corporates out of the game in the short period. But for those that are engaged, you know, that have money is flowing, it's a good time to engage with those corporates. In general, like, you know, other VCs, other financial investors like to see other financial investors on the cap table because they have the same motivations, right? There is not this sort of possibility that the corporate is redirecting the company to serve their own needs or to get side benefits that take the startup off the target, you know, the general purpose target rather than the corporate's own initiatives and their corporate's own strategies. So that all is very much an it depends situation, because obviously some corporates are spectacular corporates to get involved in the future possibilities of a company. And a lot of VCs also love to have corporates in because it also opens up a possible acquisition path, a possible exit strategy. So it's very dependent on the corporate and how active they are and how helpful they are to the company. There's a lot of different types of corporates out there.
Yeah, maybe I'll just add to Sean's comment. I think if you're a late seed or a Series A company, be very thoughtful about getting involved with corporate VC. As Sean said, there are good ones, but there are also bad ones. And a lot of companies pursue corporate VC for the wrong reasons, which a lot of times is just some sort of validation that a big company is interested in my platform. But the vast majority of the time, you're not negotiating from a position of strength with those corporate VCs. So, you know, we encourage our companies to keep a nice warm relationship and keep those VCs, you know, apprised of their progress. But generally speaking, we find it, you know, those investors, you know, a lot of times are kicking tires, trying to get information, but are not going to write a check unless they can put a pin in a map when they know they're going to be able to launch your product. And, you know, that investment, you know, is going to be accretive in the near term. So, you know, I'd say be at least a little afraid of jumping into bed with a corporate VC. I don't think it's as bad as it used to be, where someone would see a corporate VC on your cap table and they'd go, well, if they don't buy you know, it's no good, we're out. I think that, you know, that has changed now, where it's much more acceptable to have a corporate VC on your cap table. But it still does raise questions. You know, if you got that corporate VC in your seed or your Series A and they don't come back in for your next round, that's going to raise a lot of questions. So I think a lot of startups don't think about the downstream consequences. They're just sort of focused on the near term of, wow, you know, if JJDC wants to come into my company, man, I must have something really good. But you got to be careful, because it can be a little bit like the two happiest days in a boat owner's life, right? The day you buy it and the day you sell it. Well, the day you close it's your happiest day, and your worst day is when they don't buy it or they don't come into your next round. So I think it pays to be more mindful about those sort of corporate VC relationships.
I can add that I agree. It's a little bit like dating. I think you want to talk to many corporate VCs, but don't actually marry one. Just get them for information, so that you understand what could possibly be your exit strategy down the line. So you know you're not doing something that is completely, you know, unacceptable. You just want to increase your chances of talking to corporations down the line for a potential exit. But if you marry one of them too soon, then it really diminishes your options. There's really no other way. And, you know, they change their minds. At least with a venture capital fund, you know that they're in business, and that they're in business to make money, and that they're predictable to the extent that you understand, you know, when is their investment period and when they're going to have an exit and what are the returns. venture funds are very upfront about all of those expectations. So you have to worry just about the chemistry with the people. But with a corporate VC, they could change their mind next year. They could not exist next year. They could completely, the people could be gone, you know, as opposed to partners in funds that are going to be there for the duration. So I think it's kind of a very slippery slope. It's just an easy trap to fall into. And that's where my pitch for, you know, working with advisors comes in, because as entrepreneurs, it might be easier to get in the door, some of these corporates, because of the way they're set. I mean, they're set for customer service in general, corporations, while funds tend to be more difficult to reach, and, you know, it's hard to get through. But if you have the right advisor or counselor or someone with relationships helping you, I think it's best to deal with financial people early on, and then keep the corporate umbrella or exit for later.
Okay.
Amen, Julio. Well said.
Sorry?
Amen.
Thank you. But I agree with everything you said, and also Sean. I mean, the only thing I haven't agreed with is Amy's definition of old. You may remember that she said she was if she's old, man, forget it. It's just yeah.
In the end, though, like, I think you guys maybe could correct me if my stats are out of date, but I think for Series A companies, it's like 3% actually have the magical IPO. 80% are M&As by corporates, and 17% or so are you know, like other financial players buying, like, you know, hedge funds and other things buying out companies, PE firms buying out companies in those cases to take them further. So, yeah, like, in the Amy, you probably can correct me with the stats, but it's like the outcome is definitely going to be an M&A in most cases for the firms. So having those corporate relationships does matter.
I completely agree. We saw a change, I think, in the last few months in the corporate investors in funds. So one of the things we always say is, in our investment thesis, these are early stage companies. They have to be able to exit well in any market. It means that we're focused on companies that are liable to be an M&A event or an acquisition, not an IPO. And when we were saying that in January, you could see some of the corporate and institutional investors that just shut them right down. Family offices were more excited, and now they think, wow, that was a great strategy. So I think, you know, just that shift in the public markets was helpful for that kind of investment thesis that acknowledges that exactly what Sean is saying.
Also, like, even for us as venture capitalists, like 20 to 30% of our LPs are actually corporates, because they want to see the scope of what the investments are and what the future it holds and what the direction is. You know, that's several dozen companies that are trying to look at what the trends are and trying to identify companies. So they are looking to invest in you know, in innovation, because frankly, if they don't, you know, they're dead. You know, it's the shortest period of time in history. I think, what is it, 13 years before somebody gets onto the S&P 500 and when they're irrelevant and forced off the S&P 500 because, you know, their blockbuster video model no longer applies. So, like, you know, they have to continue innovating. They know that the innovation comes through startups. And that's, you know, so the smart ones, I mean, that's why so many corporates are being so heavily involved in VC today, whereas before it was kind of a rare thing 15 years ago.
Great, thank you so much. And we have just maybe 5 minutes. Can you please share what has changed in your investment strategies, if anything, due to COVID? Will you do more online pitching from now on? Will you invest if you never met a person in real life? Will the deals be faster? How this whole process changed? Thank you.
I can say that even before I was mostly doing work virtually, and I think now much more people are amenable to that before were not. So I can see a future where much more hybrid opportunities will be available, that not everybody will demand face-to-face first. So I've seen a tremendous shift, particularly because our work is international, that 85% of people that before wanted only face-to-face deals now are willing to do it. So yes, it also shortened the length of time and ability to connect with people that otherwise would have never been able to.
I would say we have also experienced that, what Ingrid has described. Lots of the meetings are now virtual, and especially in the pre-deal period where we discuss on terms, on evaluating the company, on potential collaborative dynamics, etc. But I would say, okay, post the transaction, and in order to work really as partners and, you know, roll up the sleeves, sharpen the pencils, and get things into action, you really need to maintain a physical contact, post the transaction at least. Most of the pre-transaction meetings can be done online, not the final ones, the concluding ones, but it's a reality that most of the things have been converted to virtual meetings. Yeah.
And I can say in our case, in my case, a lot of the meetings even before were conducted virtually as well, and we're a team of 3 partners based in London, Armenia, Yervand, and Singapore. So even between ourselves, we operated as a virtual team, and now this is going to accelerate, and it's becoming more acceptable for every person to have this sort of interactions and to accept that as the option. And yeah, I agree that physical connection is important, but that can happen after the deal is done. So I think I'm currently meeting a lot of people, just continuing in the same way, and it's pretty productive. So I shall say.
And for us at SOSV, you know, running accelerators, we've always probably 90% of the teams that we invest in a $250,000 check. So it's not a very big check, but $250,000, 90% of those deals, we never saw the team in person. We always did it with Skype and Zoom now, of course. And so that's sort of a repeating pattern. For follow-on checks of up to $1 million, $1.5 million, $2 million, I would, I definitely really want to be meeting the people and spending a lot of time with them. That's with our accelerators. We spend a huge amount of time with people, and there's nothing quite as good as being present and working with people shoulder to shoulder for weeks on end or months on end to know what they're like for bigger checks. So I do think it's hard. I've talked with a bunch of VC friends that are investing at the later stages, you know, their first checks being 2 or 3 million, and they are saying they are doing some deals. So it is happening, but I personally would be very uncomfortable with it.
Let's see. Maybe you change your mind. Okay.
Also, I've talked to a friend VC out of Boston today, and they're later stage, and same comment of it's so important to see how the team, who is the personality of the founder, and how they communicate with each other. Because like one thing is their perfectly rehearsed pitch, another thing is what's the real life communication, what's the energy between the teammates, how well are they. We definitely want to spend more time with founders, go for lunches and see how they react in unusual situations as well. Because I mean, COVID is an emergency, but then it's like, oh, life is up and down, and how do you hold that, and how do you have your leadership stance, and how do you lead the team even in a time when you have no idea where your company is going. And that's something to be tested, and it's still tricky to do online. Hopefully technology will get there, but yeah, for now it is what it is, but bigger checks for sure, meeting in person.
Okay,